If you want to invest like Warren Buffett, one of the greatest investors of all time, you must understand his principles for success. From a young age, Warren knew he would be rich, and today he is worth approximately $100 billion. Warren's early business ventures included buying 6 packs of Coca-Cola for a quarter and selling each can for a nickel. He also sold newspapers and magazines door to door and collected and sold golf balls. In 1942, he invested in a stock called Cities and Services, and his return on investment was substantial. Together with his partner Charlie Munger, Warren has created one of the largest corporations in the world. To become successful like Warren, you need to understand his investing principles. He looks at the management team of a business before investing in it. If they are talented and competent, he buys shares in the business. He also believes in owning a non-controlling but substantial portion of a business instead of buying 100% of it. This allows him to own hundreds of companies without having to run them all. Warren has invested in a vast amount of businesses over the years, ranging from lollipops to airplanes. Some of these businesses have produced profits ranging from 25% after tax to far more than 100%. However, some have had poor returns due to missteps in capital allocation and evaluation of the dynamics of the companies and the industries in which they operated. To avoid making mistakes in investing, you must focus on the future productivity of the assets you're considering investing in. If you cannot make a rough estimate of the asset's future earnings, move on to another opportunity. Warren believes that you do not need to be an expert to achieve satisfactory investment returns. You must recognize your limitations and follow a certain core strategy that will work reasonably well. Keep things simple and do not take excessive risks for quick profits. If you focus on the prospective price change over contemplated purchase, you are speculating. Do not be swayed by people who claim to predict the future price of a stock without solid evidence to prove it. Warren's investing strategy involves focusing on the playing field and not the scoreboard. He advises against keeping watch of your stocks daily because it may lead to a loss of focus on the important facts, such as the annual report of the business and future plans. Forming macro opinions or listening to macro or market predictions of others is a waste of time because it may blur your vision of the truly important facts. When it comes to the management team, it is important to consider whether or not they are competent, regardless of emotions. This is especially important for stock owners, as irrational behaviors and emotions of other owners can often cause them to act irrationally as well. With so much chatter about markets, the economy, interest rates, and price behavior of stocks, it is easy to become overwhelmed and make irrational decisions. While some investors believe it is important to elicit dependence and consider acting upon comments, it is crucial to avoid taking investing advice from someone who doesn't have a clue about investing or the stock market. If a friend or coworker advises investing in a particular stock or business, it is essential to critically analyze the information they are providing and conduct thorough research before making any decisions. It may turn out to be a good tip, but it is crucial to do your own due diligence before investing. A flash crash or other extreme market fluctuation can be detrimental to the average Joe, but is rarely harmful to a seasoned investor. They see the opportunity where others see red flags and smoke. Having cash reserves available is essential for these moments, as it provides a great opportunity for the true investor. Warren Buffett has advised having a reserve for such moments because the market will bounce back. It always does. When Warren and Charlie buy stocks, they view it as a portion of the business. Their analysis is very similar to that which they use in buying entire businesses, first estimating whether they can sensibly predict earning ranges for a 5-year period or more. If the answer is yes, they will buy the stock or business if it is selling at a reasonable price. Warren Buffett has stated that in the 54 years he and Charlie have worked together, they have never forgotten an attractive purchase due to the macro-political environment or the views of others. In fact, these subjects never come up when they make decisions. Therefore, it is important not to let small circumstantial issues hinder you from making a good investment. For most investors, studying business prospects is not a priority in their lives. It is wise to conclude that they do not know enough about specific businesses to predict their future earning power. However, Warren Buffett has good news for non-professionals. The typical investor does not need their skills. In aggregate, American businesses have done wonderful over time and will continue to do so. The goal of the non-professional should be to own a cross-section of businesses that, in aggregate, are bound to do well. The low-cost S&P 500 index fund will achieve this goal. Warren plans to give away most of his fortune to charity upon his passing. In his will, he advises a trustee to invest 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He believes that the long-term results from this policy will be superior to those attained by most investors, including pension funds, institutions, and individuals who employ managers. By employing these habits, including focusing on the management team, owning a non-controlling but substantial portion of a business, and focusing on the future productivity of assets, keep things simple. Do not take excessive risks for quick profits. Do not be swayed by predictions without evidence. Focus on the important facts and do not get caught up in macro opinions or market predictions. Thorough research. Not taking investing advice from clueless sources, having cash reserves available, and owning a cross-section of businesses through a low-cost index fund, one can become better equipped to become wealthy. Thank you for watching this video. Join the Wealthwise community today and start your journey to financial empowerment. Subscribe, hit the notification bell, and let's achieve financial success together.